Thank you everyone for joining us. I'm really excited to bring you this property in Jacksonville, Florida. It's called the Portofino Club Apartments. And if you're familiar with Jacksonville, you know this location is great. There's always something going on and there's a lot of growth in the area, which helps preserve the premium rental rates that we currently have. One of the more exciting things about the property is that it's a well-kept property that was built in the 80s. It's got plenty of green space, and now we've got the ability to bring this property back to its former glory. Of course, I've got to do disclosures. You all know how this goes, so I'm not going to read all of it to you, but this is all available in the pitch deck and you can download it and see all the details. In essence, all investments have risk. You should know what those risks are. And when in doubt, consult a professional to vet the project, whether that be your CPA, your attorney, or whomever you like. So here's just a quick summary, and we'll dive deep into all this a little bit later. Like I said, this property was built in the 80s, 1986 to be exact, back when things were really built to last. And also before after they stopped using galvanized pipes for the plumbing, which is really good for apartments. There's 230 units. They're all garden style apartments. The property is located in Jacksonville, and particularly in the affluent Hidden Hills neighborhood. If you're not familiar with that area, it's surrounded by high-end houses. It's got a park with soccer fields across the street. And then adjacent, it's got the Arnold Palmer designed Hidden Hills Golf Club, which is really nice. The purchase price was just over $34 million. So it comes to approximately $148,000 a door. And again, if you're familiar with the area, you know that's a phenomenal price. It's actually 20% below a previously contracted price on this property and 23% below the current or the most recent comps. There's a lot of job growth and population expansion in the area, and the housing costs continue to rise dramatically in Florida. And that high cost of housing puts more demand in the apartment complexes, which puts us in a good place to be in this project. The median household incomes here are very strong, over $83,000. And the area really caters to families. I mentioned the park, for example, across the street, but the property's amenities and the unit mix have also led or attributed to the solid occupancy rates. They're 93% over the last 12 months. There's a lot of nearby employers, as I mentioned, the golf course and Heritage Beach are really close. Downtown Jacksonville is only 25 minutes away, so there's numerous employment options at a close distance. The loan on this property is really optimal as well. $16.7 million of assumable debt, and that debt is at 4.99% for 7 more years at a fixed rate. That should carry us past the initial investment period, and there's an additional $6.8 million supplemental loan, which leads in this case to a blended interest rate of 5.64%. It's got 12-month interest only, and then 7 years, or the remainder of the 7 years, is fixed. So this blended rate alone is fantastic. You know, getting anything right now below 6.75 or 7 is extremely difficult. And to have that rate fixed for 7 years is great. There is a plan to modernize 196 of the 230 units, and that's to be able to close the rent gap between Portofino and the newly constructed or renovated properties in the area. Those renovations will take place over a 3-year period so that they have a minimal impact on the cash flows of the property. Let's take a quick look at the targeted fund projections and targeted returns for the fund. We're looking at an average annualized return of 26% and an IRR of 20%. Both of these are phenomenal for right now in this market. And we're looking at an equity multiple of 2.3 over a 5-year period of performance. These are projections, of course, but we believe these numbers are sound and appropriately conservative. And in a moment, I'll turn it over to Mike Haig, who is the director of ATX. ATX Acquisitions is the team that's putting all this into place. They're going to be the ones who are executing this incredible business plan. And you'll see that their track record for these types of projects specifically is very impressive. So with that said, welcome, Mike. Please take it away.
Thank you. Yeah, and to give you a brief overview on who we are, going back in time, our founding team started investing in real estate in 2005. And then coming into the crash around 2008, they were able to work through their portfolio at the time without losing any investor capital. And I think it's a feather in the cap to the founder and the founding team to have that type of track record. But it's also a very good experience going forward, of course. So that's something that's deep in our DNA is being able to work through different market cycles. But starting out around 2009, we started investing in the Florida market, and we also were investing in Texas at the time. We were really looking for markets where there were high growth states, where population was moving, where jobs were moving, where companies were moving, where the quality of life and the affordability of life is a little bit lower than what you would see in a lot of, or a little bit higher, right? A little bit higher quality of life, more affordable lifestyle than what you would see in a lot of the gateway cities, the traditional real estate investing markets. We were pretty early in identifying Texas and Florida as great growth opportunities. Now you look back in time, and that seems like an obvious play, but at the time that wasn't quite as obvious. So we've been a little bit contrarian over time, and especially investing heavily in those markets in multifamily coming out of the GFC. I think that that's something that is a bit unusual, and a lot of people at the time were scared to invest in real estate and were wary about investing in multifamily real estate, when really that was the perfect time to be buying these properties. So from 2009 until 2018, we acquired 99 properties throughout Texas and Florida. At peak, we had $2 billion in AUM, 17,000 units. Jacksonville is a market that we've done 11 full cycle deals in. It's one of our favorite markets over time. Tampa also has been an area that we've been very bullish on historically, and an area where we've done a lot of our acquisitions as well. But looking back at the timeline of our firm in 2019, we took a pause on most of our acquisitions and started to become net sellers throughout our portfolio. And today we're down to about 15 properties, but we've seen that really beginning last year, we saw that there was this huge opportunity to buy properties at heavily suppressed valuations due to interest rate hikes, the fastest rate hike cycle since the 1980s. So we saw that it was a good opportunity to buy again. So we've been looking at a lot of deals over the last 2 years, and this deal stands out as the best deal that we've seen over the last 2 years. And just to add a little bit of color to the executive summary so far, the backstory on this particular deal, we've been, like I mentioned, we've been looking at pretty much everything that's come on the market in Jacksonville over the last year and a half. We've been very excited to have the opportunity to buy either distressed assets or from motivated sellers. The story here is the primary owner actually didn't want to sell the property, but they had a joint venture partner who had a sell right, and they were at the end of their term. So they were really pushing them to sell. Mid last year, so in June, they locked up. They had a contracted buyer at $185 a door. We had offered on the property at the time, close to where we are today, and obviously we were not awarded the deal, but we kept in touch with the broker. And in the fall, they came back out at $165 a door. They had pulled out of that contracted offer because the primary owner, who didn't want to sell, thought that they would be able to recap the property and hold on to it because they love the asset. Unfortunately for them, but fortunately for us, they were not able to do so. So they came back in the fall at $165 a door. We got under contract at $148 a door, as mentioned. We were not the highest bidder here, but in the market today, where we're an established group that has done over 100 deals, where we never retrade, there's certainty of close, that carries a lot of weight. And we have very good relationships with the brokers in these markets as well. So even though we weren't their highest bidder, they pushed the seller to accept our offer. So that's just an advantage to being in these markets a long time. It carries a lot of weight. I mentioned on the track record, we've taken 11 deals full cycle. We've averaged a 27% net IRR, and typically we've underwritten those on the acquisition side for a mid to high teens. So we've outperformed in the market historically, and we're really excited to be back in the market again today with this particular deal. I think the executive summary here already was covered very well. When we look at the property overview, the current ownership did a great job of completing many capital improvements. So they put a lot of work into exteriors. They put in new roofs. They put in new asphalt and new gutters in 2020. So that's a big positive for the property. Clubhouse and office upgrades. They put a lot of work into HVAC replacements, parking lot, new asphalting there, new landscaping throughout the property. So the exteriors and the common areas look great. The interior renovations they had done kind of spotty or mismatched interior renovations across 147 units over the course of time. So that's where we're seeing a lot of opportunity here. And our team has done 100 of value add deals like this. We have a property management team and construction management team in-house. So, we know how to do it. We've done it many times historically. I think another advantage here for executing this particular business plan is our property management company has, they primarily manage for other owners and operators. That's about 90% of what they do. So they manage for 7 other properties in this market. That gives us a very good perspective on what the tenant's willingness to pay is. It gives us a very good perspective when we're formulating our business plan, when we're identifying, what are the actual CapEx costs, what's the ROI expected to be on those interior renovations. And I think that that's absolutely critical to have boots on the ground in a market like this when you're rolling out a value add business plan like this, and to be partnering with a group who has done it many times and done it successfully. So when you're looking at this slide here, the unit mix, you can see it's predominantly 2 bedrooms, and so this is catering to younger families. This is catering to younger professionals who want a little bit more space. On the family side, it's in a very good school district. It's in a high median income area. So it's surrounded by single family homes. As mentioned before, it has very good access to good retail nearby. There's a Publix right nearby. High-end shopping, designer shopping is about a 15-minute drive away. The beach is about 13 minutes away. So for younger families that want to live close to major employers, who also want to live close to good amenities and be in a very good school district, it really fits the bill there. And as far as the community amenities, it has all the amenities, that compare very favorably to the newer product that's on the market. It has a putting green, it has business center, a fitness center, a nice poolside lounge area and grill area. And all of those have been improved, like we mentioned. A couple of them, which I'll get into, we'll put a little bit more CapEx work into, but overall, it's a very well-maintained deal. You'll also notice on the kind of the property overview here, the occupancy rate here is very strong, 97% today. This property has averaged mid-90s occupancy for the last 5 years, outside of a little dip in COVID, like most properties had. And a lot of that can be attributed to where it's located. It's pretty isolated from other multifamily properties. The closest comp is about 15-minute drive away. So it's really surrounded by single family homes, and that has helped it be a little bit isolated from any competitors in the area. So the business plan, we're going to put in about $2.5 million into the property. Most of the exterior common area items are really just about having enough in the budget to address maintenance as it comes up, plumbing repairs, HVAC replacements. We are making some improvements to the leasing center. We will upgrade the landscaping a bit across the board. But for the most part, the exteriors look great. The interior package, we're planning on spending about $6,700 a unit here. And we think that will provide us the rent bump that we're seeking, which is the 190 plus here. We also have opportunities here to generate ancillary income. So reserved and covered parking. This property has covered parking throughout the property. We've seen a strong willingness to pay from our tenants at our other properties for having, a spot in front of their building on the covered parking side. People will pay extra for that. And then having washer dryers in units is a big perk that people are willing to pay. So that is something else we're rolling out as well. In total, 196 of the units will be renovated. Stainless steel apartments, quartz countertops, new cabinet fronts, fresh paint, vinyl flooring, subway tile backsplashes, basically bringing it in line with the higher end new comps in the area. So yeah, I think we can move on here. This just provides a little visual of what the finished renovations look like, where you can see the quartz countertops, you can see the nice tile backsplash, you can see the nice clean white appearance, which is popular today. Stainless steel across the board, and the same in the bathrooms. Now, when we're looking at rent comps in the area, we've selected some unrenovated comps to compare where we are today. You can see today we're sitting at around $14.15 a unit, which is about $1.51 on a square foot basis. When we're looking at the unrenovated comps that are nearby, and I say nearby because it's kind of relative, where the closest one is 2.5 miles away. Those on average are sitting at 163 on a per square foot basis. So there's room to push rents here, which is one thing we really like about the deal. On the higher end comp side, there's a couple of newer deliveries. So you have the 2017 and 2015, the Lux at Sorrel and the Sorrel. Those are sitting at $1.70 a square foot. So you can see here, what we look for is once we roll out that renovation, where will we sit compared to the higher end comps? And we'll sit about a little over 7% below those higher end renovated comps that are about a 15-minute drive away from the property. And most of these other properties, just for reference, are in areas that are not quite as good. Crime is a little bit higher, median income is a little bit lower. So that's just something else that we keep in mind too when we're looking at these properties. On the sale comp side, I mentioned before that we're getting at 20% below a previously contracted offer. When you look at the sale comps over the past year, we're about 23% below. So it's a fantastic cost basis on a cap rate cost basis. We're coming in at around a 6.2 cap. That is also a cap rate that we haven't seen on many acquisitions over the past 2 years. So basically, no matter how you're looking at it, if you're looking at it previous contracted, the other comparable sales, entry cap, it's a very attractive property here. And we do have we do have a little bit more detail here where we're breaking down with some of the comps here, like Madison Manor and Miramar. These are in higher crime, lower demographic areas of the submarket. So they're not very good comparisons when you're looking at the overall sale comps, but we wanted to point that out in the overall list. So Jacksonville as a whole, it's one of our favorite markets and one of the markets we've been most active in. And that really comes down to the population and employment here. One of the key things we look for in our markets is what are the industry drivers, and do you have very strong diversification there? Jacksonville checks all the boxes. You have a very strong mix of financial services firms, biomedical, consumer goods. There's other industries there. There's manufacturing. We presented a little chart here on the cost of living index. When you look at other cities, you can compare Jacksonville to Austin, for instance, where I am today in Austin. Jacksonville has a much lower cost of living compared to Austin. The average home appreciation has continued to go up significantly each year. And so it's one of these markets where it's very unaffordable for people to buy a home, which is obviously going to increase demand for a property like ours with a lot of 2 bedrooms. It's a good substitute for living in a home, or a good bridge until you can afford a home as well. Most of the Wall Street firms have locations down here as well. Bank of America, Citigroup, JP Morgan, Wells Fargo. So a lot of financial services. Over from 2017 to 2022, to give you a good timeline there, Jacksonville had almost a 24% increase in real GDP growth. And when you compare that to the national average was around 12%. So it's outpacing across the board in GDP growth. Employment growth has continued to increase substantially as well. It's gotten a lot of accolades from various publications, various analysts. Wall Street Journal listed it as the #3 hottest job market in the country. It was ranked as the #6 hottest housing market in the country in 2023 from Zillow, which obviously caters to multifamily demand. It was ranked as one of the 5 supernova cities by the Urban Land Institute. So this is when they're looking at, what are the cities that have absolutely just blown up, that are medium-sized cities over the last few years. It's the 14th fastest metro area in the U.S., according to U.S. News and World Report as well. And then it also tends to have a pretty strong, there's a military base there. So there is a military presence throughout Jacksonville where you have a lot of retirees that are making it their permanent home as well. So we started with Jacksonville as a whole, but why we like this specific location. Highlighted a couple things. St. John's Town Center, this is about 15 minutes south. This has a lot of higher end shops and designer shops as well. Right across the street from the property, there is a golf course called the Hidden Hills Golf Course. It's an Arnold Palmer signature golf course. It's basically a stone's throw from the property. It's just a half-mile north. So that's just a really nice, attractive amenity. And it's kind of nestled up, you can see there's kind of natural barriers to build new product in the area, kind of nestled right up against the golf course, close to the nature preserve, and then with single family homes throughout it. I highlighted a little bit before. You have that town center that's 15 minutes away, the beach 15 minutes away. Jacksonville Airport is 27 minutes away. The other thing I would highlight about the overall location is this has been the best performing submarket when you're looking at market rent growth over the past year. And then within this submarket, this Hidden Hills neighborhood has been the strongest performing part of that submarket. When you expand the submarket and you're going across the two highways that you can see in this photo, that's where there's a little bit more supply. So we're very isolated from that. So if we're choosing the ideal spot in Jacksonville to invest, we're choosing this submarket, and then we're choosing this particular neighborhood. Moving into the capitalization here. So we mentioned the attractive assumable loan. When you're looking at the entry cap, there's very strong positive leverage here. Obviously, the benefit there is we have strong in-place cash flow to cover our debt service over the course of the hold period. That is fixed rate. It's a Freddie, agency loan. We're very familiar with working with Freddie. That's been probably the most common debt that we've had across our 100+ deals. So that's very attractive debt across the board. Exit cap here, our assumption is a 5.75. Basically, what we did is we took a look at different industry analysis publications like CoStar, but we also follow a number of economists that have different views on where the cap rate will be in 5 years. Where we've selected an exit cap rate that is a little bit higher than the experts that we follow. And then when you're looking at the average market rent inflation, we tend to have pretty conservative underwriting. We're assuming an average of about 2.9% on an annual basis. I mean, even when you look at inflation over the last 5 years, inflation's been above 3% on average. So the market rent inflation here that we're assuming is very defensible and very conservative. And I mean, we think it's going to outperform that, but we would prefer to, underpromise and overdeliver. On the hold period, we model out a 5-year hold typically. Our average has been 4 years, so we'll be somewhere in that range, 4 to 6 years, let's say. We assess our properties on a monthly basis. We do a portfolio analysis to identify the opportune time to sell here. Our fee structure, 1.5% on the acquisition fee, 2% on the asset management fee. Asset management fee is basically just to cover the overhead on the teammates of ours that are managing that business plan and making sure that we are getting the property to where we have underwritten it today. We also have a construction management fee of 5%, which is also below market. Typically, our construction management team for other owners, they'll charge around 7.5%. So they give us a little family discount there. That's basically just to cover the general contractor. We also have seen, other groups that don't have construction management in-house. They basically are just baking that into their overall CapEx costs. But normally there's a significant margin that they're paying a general contractor to come in and manage that. So having that in-house cuts out a lot of costs there. So that's a significant savings for us to have that fee in there and for our investors, of course. And then in the event that we refinance, we do have a small fee there as well. I don't think there's anything else that we need to point out here. We mentioned the debt fixed 7 years at 5.64, which is a very attractive rate compared to if you were going to go out and get a new loan from Freddie today. On the pro forma financials, take a look here. We also have the underwriting model that we can provide to anybody, and we're happy to answer any questions. But one thing I would just point out is if you look at the DSCR here, we have a very healthy margin above Freddie's requirements, which is a 1.25 throughout the hold period. Very strong cash flow. And a lot of that I mentioned before with our positive leverage going into the deal. And then some additional photos of the property. Happy to provide more if you guys want as well. But you can see, the nice putting green. You can see the pool is very well done. The fitness equipment too is fairly new. It's in good shape. We're going to improve the lighting a little bit in that room as well, just and the painting in there. But overall, it's in good shape. The lounge area by the pools are also new and in really good shape. And you have the nice amenity with that pond in the middle. So we do see that some residents will pay a little bit of an extra fee to have that balcony view of the water and the fountain there as well. And then just going into a little bit more detail on us, I mentioned this from the beginning, but we've acquired over 17,000 units over our history. Our total exit value, which includes our sold assets, and then if we sold our remaining assets today, is 2.1 billion. We've averaged a 20.8% net IRR. If you compare us against other groups that have been active over the same timeline, we're in the first quartile. And then our average net equity multiple has been a 2x over an average of a 4-year hold. So very strong when you compare it to any other sponsors in the market. Our Jacksonville track record, we have a little breakdown of the 11 properties that we've owned, operated, and sold there. The total exit value of all the properties that we have sold in Jacksonville is 185 million. And we've had very good value appreciation through our renovations historically. So our value appreciation on average has been close to 121%. And you can see, the timeline here of when we bought the assets and when we sold them. And like I mentioned, this is one of our best performing markets and one of our favorite markets. And we started investing here in 2011. So we've been in this market for a long time. Our founding team, Peter Rex is our founder. He's the one who really started to invest in real estate in 2005. He's been through multiple market cycles. Like I mentioned, he has a JD from Harvard and got his BA from Georgetown. He's basically been involved in every part of the company since the beginning. His partner and childhood friend Dan French is our CEO. You can see him listed here. He's been working with Pete since the beginning and continues to be very active with every decision in the firm to date, from acquisitions to dispositions to the type of capital partners that we bring in. Our other partners here, like Rachel Ridley, she's been with the firm for many years as well. CFO, she runs the accounting side, runs asset management. We have Chris Green, who also has a MBA from Harvard. He's got his undergrad from Vanderbilt and has a very strong engineering and operations background. He's involved in the investment committee, runs a lot of the asset management as well. But overall, you can see that there's very strong continuity with the team. They've been together for a while. They've had a lot of success together, and we're looking forward to. They're all looking forward to working on this deal as well. On the rest of the team here, Baron Davis heads up our acquisition side. He played baseball at Harvard and has been in real estate acquisitions for almost a decade now. I've been with the team for about 3.5 years. Got my undergrad at Notre Dame, MBA at UChicago, and I work on the acquisition side, but also with our capital partners and with any investors, of course, that we have. Previous to that, I spent time at the University of Chicago's endowment, which was just a great overview of different asset classes and different strategies. And coming out of that experience, I was really excited to concentrate on real estate, in particularly multifamily. I think it's a fantastic asset class that everybody should be invested in. And then Ileana Cavazos is our director on the accounting side. So yeah, we can skip past here. We do have some additional detail in case you guys are interested on how the units are laid out, how the property is laid out, where those ponds, where those amenities, the pools and everything are located.
All right. Thank you so much, Mike. I think this project is more exciting each time we go through all the material. So let's get down to the meat and potatoes, so to speak. Here are the fund splits and what a sample investor return would look like. Within the fund, you're getting an 8% preferred return, and there's an 85-15 split thereafter. So all the fund investors are getting 85% of the profits above the 8% preferred return. So the way that looks if you were to invest $100,000 is what you see in front of you. If you were doing 50,000 or 200, just divide it in half or double it appropriately. The 100,000 just works easy with the numbers. You'll notice that year one is a little below 7% cash on cash. And then year two has a slight drop from there. And then after that, it starts to build back up. As we mentioned, the unit upgrades taking place between years 1 and 3, they're going to have an effect on the cash flows. And then also the loans are interest only the first year. So the second year we start having principal reduction, that affects that second year cash flow as well. After that, though, the returns accelerate and then really kick it into gear by year 5, which is also the anticipated exit timeframe. So there you'll see the profits from sales as well at the exit. All in all, your anticipated return on $100,000 is $238,119. These are projections, so the 119 to hit exactly at the end may be a little difficult, but I say that jokingly. These are projections, though, but we believe there's a strong team in place. It's a good market and a great property. So if this project is of interest to you and you're interested in investing, the timeline for doing so is as follows. We need signed commitments by May 25th. The capital call, meaning that when you have to wire the funds, is June 1st. So the way to start is to review the offering information, starting with this pitch deck. If you have any questions, reach out to me and we'll make sure that all your questions are resolved. And then when you make your commitment using the website or the email, you might have received both. After you get your commitment, we'll send you the documents to view and sign. And there again, if you have any questions on the documents, set up another call with me. You don't even have to actually set up the call. Just give me a shout and I'll help you through all of that. We do all the signing digitally. So it's very quick. You don't have to print out a bunch of papers or anything like that. And then you wire the funds by the deadline. As always, this project is first come, first serve. We have a set amount of capital that we can deploy or that we can raise for the project. And when it's full, it's full. We don't have anything else we can do about it. Here's my contact information. If you want to reach out to me, it's been great sharing this opportunity with you. I also want to thank Mike and everybody at ATX again for letting us partner on this. We're really looking forward to see what the future holds here. Thank you so much for your time today. I really appreciate it.